This is the other article, the top 7 reasons. I had 9 reasons, so let's go through these. Missing paperwork and undeclared income. Tax season is underway with millions of Americans putting together their returns for fiscal year 2021. While less than 1% of all taxpayers are audited in a given year, movies and TV shows have helped create a horrifying fear of trudging shoeboxes stuffed with receipts into the IRS's agent's dimly lit office. According to the agency's website, an audit is simply a review of accounts and financial information to ensure information is reported correctly according to the tax laws and to verify the reported amount of tax is correct. That's what it is. Often an audit will be triggered at random, and they do random audits. Many are random. But certain kinds of taxpayers and certain behaviors are more likely to draw the IRS's attention than others. Here are 7 common reasons you might be audited and what you can do to lessen the odds. Okay? Find out what, okay, whatever. You have missing or mismatched paperwork, and we already talked about that, right? That's the 1099s. They send you one and you don't send it in, then they know that it's there, and so that'll create a correspondence audit. The last year, the federal government offered a variety of financial support programs to offset the economic effects of the pandemic, notably the child tax credit and the earned income tax credit, and a third stimulus check. Remember, these are the things I already mentioned. And the American Opportunity Tax Credit, which allows you to claim up to $2,500 in education expenses. But you have to show you legitimately qualify for these benefits. If last year you claimed no child tax credit and this year you claim 3 kids and they're not babies, it's going to trigger a letter from the IRS. That doesn't mean you're always in the wrong. You might have had a child in May 2021, and the IRS is working off information that it has on you from 2020. While the Earned Income Tax Credit is aimed at lower income households, taxpayers who claim it are among the most likely to be audited because you're getting money that you haven't paid in, according to the 2021 report from the Treasury Department. That's because fraud is so rampant. According to the IRS, some $16 billion, or 23.5% of all these payments, were improperly paid. 23.5%. Math or data errors. We talked about the math error letters that went out to the IRS on this show. While simple math errors won't usually trigger a full-blown examination, they will garner an extra look and a slowdown of completion of your tax return, even if the error is in the IRS's favor. So if you are entering your Social Security number wrong, transposing the numbers on your address, and other boneheaded blunders, filing electronically cuts down these follow-ups by pulling in a lot of information from previous returns and letting you load your W-2s and 1099s directly into the system. These errors aren't what they used to be, right? Most people are not filing. Although if you're filling out TurboTax or some of these free tax returns, remember, if you go to tinyurl.com/T3 free file, you can find where to file your tax returns. You can get that tax software for free from the IRS. If you make less than $73,000, it's there. You're self-employed. If you work for yourself and have legitimate business expenses, you should feel empowered to take them. Just make sure you have receipts and documentation to back it up. My advice to people who do their own business is get it off of your personal tax return. Start a business. Do it the proper way. Get the business to have their own tax return. And then a lot of these things won't be so scrutinized. If you claim the home office deduction, it has to be a space used solely for your work, for example, not the dining room table. If you claim transportation expenses, you'll need documentation of the mileage used for work. If you deduct 100% of your personal vehicle as a business expense, it's going to raise a flag. Being diligent is especially true when deducting business meals. In the past, they were only 50% deductible. Now you can claim 100% of the cost of a business meal, but you have to document who you are with, what the purpose of the meeting was, the date of the meeting, and so forth. And of course, keep the receipts. The largest percentage of Americans who are audited make over $1 million a year. Well, that's in a percentage-wise, that's probably true. You make a lot of money or no money at all. Higher income taxpayers are more likely to be reviewed, but we're talking less than 1% of the total population. According to the IRS, 2.53% of the earnings between $1 million and $10 million were audited, and 8.1% of Americans who made $10 million or more were audited. That compares to less than 1% for all tax brackets under $1 million that year. The one exception was those declaring no positive income, 4.47% of whom were audited. A negative income could be the result of capital losses or declared business expenses, which the IRS will want to scrutinize. You're in the safest position if your total household income is between $25,000 and $200,000, according to the agency. You claim too many business expenses. Now, this is where these bad tax preparers do. They exaggerate these kinds of expenses, or they take them out of whole cloth that you don't really have a business, and they take business deductions. I've had clients who this happened to. They didn't even know it. I know you sign your return under penalty of perjury, and so you should look at your return and know what it means. But people say, well, I don't understand tax. That's why I have a tax preparer. And so they gave me my tax return, and they say, sign it. I sign it. I don't know what it means. You are required to file a Schedule C form if you have business income, but it complicates your return and can make you more likely to be contacted by the IRS. She encourages taxpayers to claim every deduction they're legitimately entitled to, but she adds, you have to be extremely diligent in justifying those deductions, providing details and supporting paperwork, especially if it's on your Schedule C. Better, again, to have a separate return for the business. By and large, the IRS algorithm is looking for deductions that are outside the norm for people in your profession. The IRS has so much data, right? Everybody that's in your business files with the IRS. So everybody in your business, in that code, they know what the average deductions are. What are the average expenses for this type of business? And if yours vary than what their normal is, well, they're gonna take a closer look at you. And if you're taking a loss on your business for several years in a row, the IRS might want to make sure that your business is above board. According to this gentleman, small business owners who keep sloppy records often make frivolous business deductions. Actually, many people, most people who don't take frivolous business deductions still don't keep good records. Most people don't. When the business owner makes up expenses and deductions, they tend to stick out. Under an audit, the IRS will require support and proof of the deductions, and if not provided, these deductions will be disallowed. On a similar note, businesses that try to take incentives and credits that they don't qualify for can cause a red flag. Your charitable deductions are outsized, and we kind of talked about this already. If you itemize your deductions, you can claim cash donations to recognize charities, as well as the value of donated car, clothes, and other property. But if the IRS notices if these the donations seem out of whack with your income, the agency's computer system, called the Discriminant Information Function, continuously scans tax returns for anomalies. And these are easy to, right? If they just put in there, if your charitable deductions are more than this percentage of your income, just kick it out to us. We're going to take a look at it. If you say your salary was $500,000 last year, but you claimed a charitable deduction that's like half your income, it's going to catch an eye. For the 2021 tax year, the IRS actually suspended the typical limits on charitable contributions. Individuals are allowed to deduct charitable contributions worth up to 100% of their adjusted gross income. But doing so is likely to draw scrutiny. Makes sense. How are you living if you give it all away? You have undeclared income. This is a big one. Employers are required to file W-2s with the IRS that reflect your earnings, or 1099 in the case of freelancers and contractors, and now PayPal and Venmo and all that. The agency's computer automatically checks to see that you submitted your reported income matches up with what was your boss submitted. If it also gets notified of interest of your earnings from savings account, investments, stock trades, as well as large gambling losses, inheritances, almost any other kind of income. Sell your house, you get a 1099, right? And so you have to account for it. If you fail to report capital gains on cryptocurrency trades, it could trigger an audit. Even if you, and I have many clients that's what's happened to them. Even if you work in a cash business like a waiter or babysitter, unclaimed income can catch up with you. If someone is bringing their child to you to care for, they're probably claiming your service on their taxes. So you need to make sure it all aligns. Even a small business like a house painter will require you to be bonded. That will eventually cross the IRS's desk. For instance, if you declare $20,000 in income on your tax return, but when you apply for a home loan backed up by the Federal Housing Administration, you put down $80,000. These departments talk to each other, and eventually it's going to get you caught. Small business owners who don't keep good records also tend to underreport a major audit risk. Because the business owner hasn't kept up with their income for the entire year, when it's time to file their taxes, they tend to estimate. The problem with this approach shows up because most of the income earned has been reported to the IRS on Form 1099. The IRS can match the income reported on the owner's return to the income reported on 1099. That's why they're doing it. That's why they're getting the Venmo and everything. The IRS also accepts tips from concerned citizens. Your disgruntled coworker or aggrieved in-law may be only too happy to report you for tax fraud, especially since the agency's 2006 whistleblower program increased incentives to potentially between 15 and 30% of the proceeds the IRS collects. How far can the IRS go to audit you? Generally, the IRS will include, and we already did this, if you identify a substantial error, how long should we hold your old tax records? Since the IRS typically looks at returns for the past 3 years, it's a good rule of thumb to hold your records for at least that long. 6 or 7 years is fine if you really want to cover your bases, since the agency itself says it won't go back further than that. The 3 kinds of audits. Typically, the IRS sends 3 different kinds of notifications: adjustment letters, correspondence audits, which we already talked about, and examination audits. Adjustment letters simply let taxpayers know they owe additional money or that there is a change in their refund amount, typically because of a miscalculation. People get a letter from the IRS and they automatically freak out and think it's on audit, but it's really just an adjustment letter. A correspondence audit is a bit more involved. It lets the taxpayer know additional documentation is needed to complete their return. The IRS might ask for receipts, bills, employment documents, canceled checks, legal papers, loan agreements, shareholder reports, or even ticket stubs. An examination audit is one people are really scared of, but less than 1% of Americans are audited in a given tax year. If you have the documents, send them to us. If you do receive a letter from indicating the IRS is conducting an examination audit, you might want to solicit professional help, she says. Well, that makes sense. The process may be conducted through the mail or more rarely in person. When an audit is completed, your IRS auditor will determine what's required to rectify the situation. If you disagree, there is an appeals process. Some of the things that get flagged by the agency are no big deal, and the IRS is not always right or not fully right. In 2018, 30,000 of the 1 million or so audits conducted resulted in taxpayers getting additional money back. That's not a very big. It's always a pleasure to resolve an issue with the IRS when it's in the taxpayer's favor. Well, that makes sense, doesn't it? Anyway, that's where we are. I thought it was interesting to know what those are. So